Later today, the Federal Reserve will announce its latest decision on interest rates.
So joining us now with the preview, CBS News business analyst Jill Schlesinger. Jill, great to hear from you, get your insight of this. Let's dive right in. What is the Fed expected to do with these results?
A whole lot of nothing. I think no action. And by the way, that would leave the federal funds rate, that's the short-term lending rate, at a range of 4.25% to 4.5%. That's where we have been since December. Now, why do I think this? Because Fed Chair Powell has basically told us this. He has said over and over the last few weeks, the central bank can be patient. They can wait and see, because so far, even though we've had these tariffs, the economy has been able to create jobs and the inflation rate has remained pretty stable. So again, no action is likely today.
Well, let's talk about what's going on in the current world. You kind of mentioned some of it: unemployment, layoffs, federal layoffs, Israeli attack on Iran. Could that have an impact on the economy and the Fed?
Well, I think yes to both, because the conflict in the Middle East would most directly impact energy markets. So now, if you look back in the days since the attack, if you look at oil markets globally, we're up by about 15% just the last week or so. Now, thankfully, we entered this period with oil prices being lower than they were a year ago. So it hasn't been too terrible yet, but there is a concern that if this persists, if things escalate, or if Iran tries to block the Strait of Hormuz, through which about 25% of all the oil supplies around the world pass, that we could see more oil price movement. And also, just to be clear, we could see the supply chain disrupted. So look, I don't know if this is going to matter this minute, but obviously the Fed is keeping an eye on whether higher prices, whether because of tariffs, whether because of oil prices, whether those prices feed through the rest of the economy. I think it's just another reason that the Fed's going to stay on the sidelines for the foreseeable future.
Okay, so nothing happening right this moment now, but in the future, what does this mean, for example, for all of us consumers?
Well, I'll tell you what it means right now, and then we'll talk about what the future. What it means right now is what you know. Interest rates are high. So if you've got a credit card balance, on average, you're paying more than 21%. You're going to get a new car and you need a loan, it's going to cost you 8%. And even though the Fed doesn't control mortgage rates, they are still high. They're just under 7%. Now, look, you are happy if you're a saver, right? Because you can collect more interest on your savings accounts, your money market accounts, your CDs. Of course, if you look online, that's where you're going to find the best and juiciest rates, 3.5% to 4.5%. But if we see that this uncertainty persists, I think this situation will also persist for us, for the consumers. If we see the economy start to soften, that's when you're going to see the Federal Reserve start to lower interest rates. But they've got to feel like they're through this uncertain period before they do anything.
That's the key, the uncertain period. Hey, Jill, as always, we appreciate your insight. Thank you. Your insight. Thank you. You can see Jill regularly on CBS Mornings and the CBS Evening News. Want more analysis? You can go to JillOnMoney.com.